gosh.
Or just play your intro. Just be like, how does your intro go?
I don't know. Just get my new piano and learn it on the piano.
Go.
Hi guys, and welcome to episode 2 of the new series called What They Don't Teach You in School About Money. Of course, today we're joined again by Ollie Trigg.
Hello.
Thanks for coming back. He's back. Today's episode is about something which and I'm guessing you do, Ollie, still find very confusing.
Yeah.
Taxes.
Yeah. They're a nasty little piece of work, but they're.
I don't understand why they're so confusing.
Well, I don't really think they're actually that confusing. It's just we're making them more confusing than they need to be.
Yeah.
We did.
Hopefully, in this, we'll try and make them a bit less confusing.
Yeah.
And in preparation for this episode, I've created a PDF which will be in the description below, which should hopefully make things a bit clearer. But all the stuff I just got off the government.
Basically, what he's done is he's put a whole load of information in, and then put in the government document about taxes that's actually going to hold all the really relevant information, and we're just going to talk about the stuff we actually understand.
Yeah, all the information is basically from the government website anyway, so I haven't made anything, I haven't actually created anything. I've just put it in a slightly nicer form.
Don't big yourself up. You did well. You did very well. It looks very pretty.
Thank you very much. It's on a great new app called Notion, which we'll talk about in another time.
You're not getting paid by Notion. You don't have to pick them up. Notion you owe us money.
Okay, so today we're going to talk about taxes. First of all, Ollie, do you have a clue what a tax is? How would you sum it up?
I would say it's a compulsory charge put on certain things so that government can. No, I'm just reading your one. Basically, what it is it's a way of the government raising money back to pay for all the stuff that we in society use and for free. So that's
like
stuff
roads
like
and the
roads, army, traffic lights, basically whatever you can think of that you use. I guarantee that there's people listening to this who could think of 20 things they use in a day that is not paid for by them, and it goes unnoticed, and then suddenly actually you do have to pay for that, and they do it by tax.
Because if we didn't have tax, then the government would be even more in debt than they are at the moment.
The government would be the poorest part of our entire country, which just doesn't work.
Well, I mean, so fundamentally that's what it is, but all the different types of tax and the tax rates and how to get around paying so much tax is very confusing, but also quite vital to know. I mean, there's so much I've learned from just researching this stuff that I didn't know before, like personally. Yeah. They don't teach you.
There's a lot of stuff that I learned working for the first time, and you get your first paycheck, and it's like, great, I've done this many hours, and it's this, I should be getting this much, and then you read it, and you're like, sorry, where's all my money gone? And then I spoke to my employer, and they were like, oh yeah, you've got to pay national insurance, and you're on this tax code, and you're on this tax code, and I'm like, excuse me, it's my money, and then he had to teach me all about it. So
I think they really should teach it in school because or make it a bit more accessible.
Well, no, if they taught it in school, Matt, we wouldn't be doing this podcast. So
this is true because it gives us something to talk about. So what we're going to do is we're going to go quickly through all the different types of tax, a few more in detail, and then towards the end we'll talk about how to pay less tax legally. Because there's a difference between I get confused. Tax evasion is illegal. No. One avoidance and evasion. One is legal, one's illegal. But anyway,
I think tax avoidance is illegal. Tax evasion is not. It's not recommended.
Yeah, but anyway, there's some legal ways to pay less tax.
We are not out here trying to make you not pay taxes, guys. No, that is not the point of this podcast.
There are some very kosher ways to not pay as much tax. So let's start with the first one. When you think of tax on your income. So this is, as it says in the name, any tax on any income you earn. Well, that would be too easy because the government don't like to make things easy. So there's a few things which are exempt from this. So the things that are exempt are your first £1,000.
Hang on. Wait. Before we go there, I think so. It's a tax on an income, but there are certain stages to that. So it's not just every pound you earn, it's not yours. Like that's not how it works. So obviously you've got your first 12.5 grand you can earn a year completely tax free. So if you earn,
Allowance.
if you do some pocket money, or if you do a Saturday job when you're in school or college or whatever, chances are you're not going to earn above that £12,500 pay scale a year. So you don't have to do anything. You just have to earn the money, and as much money as you earn, that's it. That's what you get. Once you go above that, there are then certain categories of percentages of tax you pay on top of that. So I think it's up to like 25 grand. Have you got these stats?
Yeah, I've got it here. So from 12,501 to 50,000, it's 20%. All of this is in the PDF. So as you're listening, I'd open the PDF and look through. There's also an example in here. Up to £50,000, 20%. Up to then 150,000 is 40%, and then it goes to 45%. Yeah.
But if you were to earn £200,000, you're paying 0% on the first 12.5 grand you earn. Then you're paying 20% of all the money you earn between 12.5 and £1 and 50 grand. So all of that income is 20%. And then 50,000 and £1 to 150 grand is 40%. So it's not like, oh, I earn £200,000, I have to pay 45% tax of £200,000. It's not as simple as that. It is split down into the categories. So you're paying, I don't know what the average is, but you're paying like 38%.
Yeah, so you only pay for any additional that falls into the next category. So an example I've got in the PDF is if you earn £13,000 across everything in a year, you take away your personal allowance of 12,500, so your only taxable income is £500. That would fall into the 20% category. So 20% of 500 is £100. That's all you'd have to pay on 13 grand.
So what is actually £100 out of 13 grand? What is that calculation?
That's a good question. You do the maths. Well,
you keep talking, I'll do the maths.
Okay. So income tax, you pay it on things from money you get from employment, any profits from self-employed companies, rental income, interest above a certain amount, which we'll talk to you later, and some other boring things I won't go into. But there are a few things
you actually pay 0.7%.
It's not bad, is it?
Yeah. So I think most people can afford that.
Yeah. But there are a few things which are exempt from income tax. I won't bore you with them, but mainly there are a few of your allowances to begin with, and things like premium bonds, which I don't even think are a good. Well, anyway, premium bonds.
Matt doesn't like premium bonds. Matt, we've had many a discussion about this, especially with other friends, because one of our other friends has got premium bonds, and just like, what are you doing? Why are you doing that? It's great.
I think they're a bit outdated.
Yeah, I agree.
So the whole thing about tax, I didn't realise until about a year ago, is because when I was working at Waitrose, I would get my payslip and the tax would be deducted if I was to pay tax, which I didn't have to. And that is called pay as you earn as you're an employee. But the other way you have to pay tax if you're self-employed is you have to do a tax return at the end of every year, which seems easy. It's the most complicated form in existence for no particular reason.
Yeah, I haven't done one yet, so this is all Matt.
Yeah, it's very confusing. But if you're an employee, working your tax is all done for you. You don't have to do it for you. You don't have to do it yourself. But if you're self-employed, it's a massive pain. So it's probably just easier to pay someone to do it.
Is it literally just fill out a form, or is it like
it's fill out a form, but you have to have all the right information. But the government won't help you, but they still know exactly how much you've earned. And if you do it wrong, you're going to go to prison type thing.
Right.
Okay. I saw a TikTok described like that, which is kind of fair. But yeah, income tax, you're going to have to pay it after a certain amount, unless you're like, even minimum wage is going to make you earn more than the personal allowance.
Yeah, exactly.
But I think income tax is probably one of the easier ones.
Yeah, I know we're slating it, but it is, especially for a first job. I doubt your first job's going to be self-employment. So anyone out there getting a first job, don't worry about it. It's quite easy. I mean, I know I first paycheck, I was like, what is going on? And then as soon as I was educated on it, every other paycheck apart from that, I was like, oh, great, that's fine.
Yeah.
You know? And actually, it was great because I worked from October to September, on August, because I finished college in July, I then had summer off, and then I went to uni in September. But obviously there's a tax year in between that. So from October to April, I was earning enough money every month to be paying tax, to go over the threshold in that tax year. But because I only started working in October, I only had from October to April to actually earn the 12.5 grand, which I didn't do. So although I'm paying tax every week, I am only paying tax because if I was to earn that amount of money every week for 52 weeks, I would be paying tax. But I only did it from, I don't know how it was, like 23 or whatever. So when the tax year ended, I then had a form from, actually it was on the app because they're quite modern now, the government. I had the app say, oh, the government owes you £800 or whatever it was.
Nice.
Which was such a nice bonus because so technically I was paying it, but then because of the timings, I actually got it back at the end.
You got a rebate.
So the same thing happened again last year because I worked from April till September, but obviously I had to wait to the end of the tax year to get the money back.
Yeah, I think if you are an employee, the government is very good at knowing if you've overpaid or underpaid. It's trickier when you're self-employed because you've got to, give all the information to them. But yeah, on the self-employed front, I'll go into a bit more later, but one of the exemptions was you are allowed £1,000 profit before you start paying any tax. So if you're not, I don't know, you're selling sweets in the playground and you're making 500 quid, that's fine. If you're making £5,000, it's a bit different.
You're ripping your friends off at school.
Yeah.
Or you're selling a lot of sweets.
You're making a killing if you're making £5,000. But,
yeah.
All right. The next tax actually was the most interesting for me to look at was capital gains. So Ollie, for anyone who doesn't know, what is a capital?
No. See, I actually think you should explain this one because I haven't looked this up before.
Okay, I'll explain it.
I mean, I can read it if you want, but I'll let you do it.
So capital in like economics terms is like something you own, as in like in the guise of like a business, it's like a machine or something. But in terms of us, it might be a car or your house or a share in a company. That's capital. That's an asset.
Yeah.
And obviously a gain is that asset increasing in value. The government like to take money if that asset has gone up in value and you sell it on for a profit.
Yeah.
The good thing is if it goes down in value, you can offset that with your gains. So if you make a £50,000 gain, but you make a £75,000 loss, that equals out to minus 25 grand, doesn't it?
Well, yeah, it's not a very good investment if you do that.
No. But yeah, there's and like we were talking about with income tax, about being only taxed in the next bracket, whatever stays in there. Like with capital gains, you're only taxed on the gain you make. The example I've got is if you bought some fancy art for £10,000 and you sell it on for £25,000 a few years later, you're only charged tax on the £15,000 profit, not the whole 25 grand you've made.
Right.
And
is that I'm assuming the rates of the tax that you pay depending on how much what tax bracket you're in.
The exact words I've written for the tax rates. This is slightly more confusing, and it all depends on the rate of taxpayer you are. But we'll go into that in a second. Also, you might just think it's when you sell an item, but it's also when you gift an item or you swap it for something else. So I didn't realize, because I've been doing quite a bit of research about cryptocurrencies. If we were to sell Bitcoin right now, flat out, you'd have to pay capital gains.
Yeah.
If I was to swap crypto for Ethereum, I'd still have to pay capital gains on the gain I made.
What? Even though you're not actually pocketing the money, you're just switching between.
Swapping. Yeah. If it's within a certain time frame, and also if I was to gift you Bitcoin and it's increased by value, I'd have to pay capital gains on that.
Would it be you or would I be paying it?
I'd have to pay it.
Oh. Because you want to give me some Bitcoin?
No, absolutely not. But yeah, so the obvious things you have to pay.
Yeah, no, go on.
The obvious things you have to pay on are personal items worth over £6,000, except cars because they're quite spenny anyway. Property that's not your main home. Yeah. Shares and stocks of a business that is outside of an ISA, more on that later, and any kind of business asset.
Okay.
And the main things are exempt.
You're not paying these yearly, are you? You're paying them literally when you try and sell the asset.
I don't actually know how it works, but I think if you, like, for example, if you're self-employed, it has to be on the self-employed form, which is once a year. Yeah. So there was a section about how much have you made from capital gains. But yeah, so what is exempt from capital gains is ISAs, which we'll talk about more later. They're brilliant. And lottery and betting winnings, which on a side note, match betting, we're going to talk about that another time, because that's why match betting is tax-free, because it's
betting.
Gambling.
Even though it's not betting.
Yeah. I won't talk about the tax rates because they're very confusing. But if you're young, like in your 20s, you're not going to be paying in the high tax
Well,
brackets.
no, I mean, surely basic taxpayers are anyone that's paying 20 or 40%, surely, and then higher taxpayers is 45%.
Yeah, potentially. It depends on various things.
Oh yeah, look. In the caption up above, you've got personal allowance, basic rate, higher rate, and additional rate. So basic rate will be
it's only up to £50,000.
Yeah. So yeah.
So either you're paying 10% or 20% on gains and 18 or 28% on property, which is quite a lot.
Yeah.
On top of everything else. But yeah,
cool.
Very confusing. National insurance.
Well, it's actually not. It's actually not.
But what's interesting to me is about the whole cryptocurrency thing, because the whole basis behind crypto is it's decentralized.
Yeah.
Yet the government still want you to tax you on it.
But is that going to remain the case if crypto becomes a bigger thing? Are they still going?
Well, this is what I thought crypto was sort of out of the reach of government sort of thing, by its very nature. But places like Coinbase and eToro have shared their data with HMRC, so they know who's been making gains on crypto.
But surely if you did it privately and you bought Bitcoin privately and you didn't declare it,
but where are you going to buy it from?
True. Well, people can have like their own little crypto wallets that you buy. You don't buy it on an app.
But what? So if you bought it on Coinbase and then you transfer it to your cold storage device, Coinbase would still tell HMRC how much you've taken out, and HMRC will assume that's still in your possession. So any of the main cryptocurrency places you can buy, having their small print, we will comply with HMRC if we have to, which is interesting. I think the rules in America are very different. I think it's not counted as an asset or something. I don't know enough about it, but they're different to how they are in the UK. Anyway, so we'll see what happens in the next few years.
We might make another one all about it.
So as you said, you've worked for a lot longer than I have.
Yeah.
Employed, especially on your gap year. So I'm guessing you paid side. You paid income tax. You also paid national insurance, I'm assuming.
Mm-hmm.
What is it?
So basically, national insurance is the first sort of level of tax that you pay. So it basically counts towards your state pension. I was talking to my parents about this the other day. So it's essentially another tax, but it's for anyone who's employed, not so much employed and earning a certain level. So I mean, there is a certain level, and it's 183 quid a week, but that is, I don't really know what that is a year. Like, surely that's not 12 and a half. I don't know. Anyway, basically it qualifies you for a state pension. So when you retire, if you've paid your national insurance correctly, you will be offered a state pension by the government, which is essentially an income from the government every week. They'll pay you a certain amount.
I think you could qualify for other benefits as well. I don't know what they specifically are, but I think there's,
I think, it depends on your employer, but you get like healthcare, and I think it seemed to be paying for the NHS. Again, we didn't really cover that. I worked in a restaurant. You tend to be okay in a restaurant, but basically you have to pay a certain amount of national insurance every year in order to qualify to get your state pension. And I believe you have to pay national insurance for 35 years of your working life. So obviously most people will have worked for more than 35 years by the time they retire. Some of them don't, but there might be some years that you've gone through and you haven't quite, maybe you were employed in a different way and you didn't pay enough national insurance. On your HMRC record, you can see all the years that you've paid enough national insurance to qualify for your state pension. And some years you'll have qualified, some years you won't. So you can go back, and if in the year of 1995 you paid 80 quid too short of national insurance to qualify for your state pension, you can go back and in 2021 go, okay, I'm going to give the government £80 to cover off that year, and that's one of the 35 years that I have to pay. So if you're working for 50 years, you don't have to pay national insurance for all 50 of those years. You just have to pay for the 35 in order to qualify. So you'll basically go through the list. So my parents the other day were going through the list, and there was like some of them. Some years they'd covered it, some years they hadn't, and they were like, okay, so this year I hadn't paid this amount of money. Okay, that's quite a lot in one go to do. Oh look, here's a year I've only earned 70 quid. I haven't paid 70 quid. Let me go and do that so it counts as another year. So that's kind of how it works.
So it sort of makes sense. If the pension's going to be a lot of money, it makes sense to do it if the cost of doing it is less.
And it depends on how much you rely on a state pension. If you've built your net worth to not really need a state pension at the end of the year, you can choose not to take it, but it also means you don't have to pay national insurance.
And I'm guessing the rates of national insurance vary with your income, as with everything.
Yeah. I believe so. I mean, mine kind of stayed the same because.
Yeah, but I'm guessing the government will penalise you if you're a higher taxpayer.
That doesn't sound like them at all. I don't know what you're talking about.
So that's national insurance. Ollie knows a lot more about it than I do. I think I paid it like once or something.
Yeah, but you don't like to be employed by other people. You like to do it all yourself. So.
Well, the employment I have hasn't been enough to warrant it. Like when I was working Waitrose,
did you not have to pay national insurance at Waitrose?
No, I was only.
Well, actually, to be fair, you only did what, like 2 shifts a week or something?
Yeah, I was only like £400 a month, so I think I was just underneath it. Yeah, that's national insurance. So we've got 3 more tax rates. There's so many. There's also some more that I've missed out because otherwise we'd be here for hours.
Yeah.
We'll briefly go over these. There's inheritance tax, VAT, and corporation tax. So inheritance tax is a tax on anyone who's died and their money is coming to you or their assets coming to you. It is hefty. It is very hefty. It's charged at a whopping 40%.
Yeah.
40%.
Yeah, it's crazy.
So much. So
basically, the government want you to die so that they can make money out of you.
Yeah. This 40% only counts if the estate is worth more than 325,000. But if you have a house, it's probably going to be more than that.
Yeah.
And there's various loopholes to get around this, which, I've always heard people talk about transferring property into people's names, giving shares away and things like that. But yeah, inheritance tax is a killer if you don't. Ironic, is a killer. But yeah,
wow.
Inheritance tax is hefty if you don't realise it's going to come, and then you think you're getting millions of pounds, and then the government take nearly half.
Yeah.
Not fun at all.
No. Yeah.
VAT. I think VAT is a bit more well known.
Yeah. Well, it's down to 5% at the moment. It's great.
It is. But what actually is it, Mr. Trigg? Do you have a clue?
It's basically. Oh, you're going to stick me in the mud here. Basically, it's just a standard tax that is put on goods and shares that you for every transaction you make. So I'll go back to the restaurant. For every meal that we sold for £10, let's say, that's only £8 is coming to us. £2 of that doesn't belong to us. It gets paid. You're basically enjoying your meal and then paying the government for enjoying your meal.
Yeah.
Which is a bit stupid, really. But it's down to employees. It doesn't come straight out, but obviously it's on the books. So, every month they'll go, okay, so you've had this amount of sales. Oh, right, so 20% of that is VAT, right? So you owe us this amount of money.
Yeah, it's another way for government to raise some cash because they need it, especially at the moment. I mean, we're going to be paying this furlough scheme back, me and you, our generation, for years, maybe, honestly.
Just you and me. Just nobody else. Just me and you. Yeah.
Unless they all adopt crypto and then all the debt gets wiped, but we can hope.
Yeah, let's just go spend all our furlough payments. Yay!
The final one I just briefly want to touch on is corporation tax. This is if you wanted to start your own business. If you don't want to be self-employed, well, you did, but you wanted to be the director of a company, you could incorporate a company, but you'd have to pay corporation tax on any profits, which I think usually sits about 20%. But it doesn't really matter as much if you don't have a company. I think those are the main areas of tax.
Yeah, we're going to get a comment going, oh, you've forgotten this one. And we're going to be like, we forgot that one.
There's so many on the HMRC website. Just go check them out.
Yeah.
But we'd be
if you're not bored enough already.
Yeah, if you're still in. Now the interesting
we're gonna have to come up with a really interesting title for this, because if we just say taxes, they're always going to click on it.
Well, I think I'll put a timestamp down, and the next bit is going to be how to pay less tax, and everyone's going to start the episode here.
Yeah. Hi guys, welcome back.
Hi girls, hi girls, hi guys. This is the I think the interesting part.
Yeah.
Well, people aren't aware of most of these things, but the government are nice sometimes.
Matt, we've just spent about 25 minutes slagging them off. I don't think you can just turn around and be
this bit they're being nice vaguely.
Okay, all right.
So out of all the taxes, we've sort of said there's a few tax-free allowances everyone gets every year if you qualify, which you should do for unless other reasons. As we said, the personal tax income allowance for 2021 is 12.5 grand. Capital gains allowance is 12,300. So as we said, you can make £12,300 of capital gains, so assets appreciating, before you start paying any tax. Savings interest. So this is if your savings is sat in a bank account and you're earning a measly 0.001%. You get an allowance of £1,000 or £500 of your higher tax rate payer. But if you get that, you must have a lot of money sat there. Because I get like £2 or £3 a year.
Well, that's because you haven't found a good savings account, Matt.
Yeah, this is true.
You listen to last week's podcast to find out good savings accounts.
There we are. As I said, if you're self-employed, you get an allowance of £1,000. First, £1,000 from property income, and the last one is dividend allowance. Do you want to briefly explain what dividend is, Mr. Trigg?
Well, hang on. Before self-employed trading allowance, how is what? Please explain.
So that is if you're self-employed and you make £1,000 from, if you make £900 profit from a business, you don't have to declare it, because after £1,000 of being self-employed profit, you have to declare yourself self-employed and then do a tax return.
So it's kind of chucking an extra £1,000 on both of those on the personal income tax allowance.
Yes. So I think it's 12,500 plus the 1,000.
Yeah.
And anything on top of that, I think, or it might be in conjunction. Anyway, but yeah. So you get £1,000 of self-employed tax-free, and the last one is dividends. Do you want to talk about dividends?
Okay. Well, I know you like to rattle on about your Apple. You have shares in Apple, and they pay you dividends of what?
Oh,
what is it?
I got one earlier from something 1p or 5p.
Wow.
I know.
Wow. Talk about your slating savings accounts, and there's what your dividends are paying you. But basically, it's I wouldn't know the best way of describing it, but it's kind of like an income reward for having a share in a particular company.
Yeah.
Yeah.
It's how they incentivize you to, stay, kind of thing, potentially.
But there was that news article the other day about I can't remember who it was. Someone got a dividend share of Apple, and it was something like £36 million dollars or something. Let me see if I can find it quickly.
Yeah.
So Berkshire Hathaway, do you know who they are?
Yep, Warren Buffett's company.
Guess how much they get per year from Apple in dividends? According to Coingrams on Instagram.
The really trusted source. I think they get millions. Because I think they have quite a big...
Go on, put a number on it.
20 million.
$800 million a year in dividends.
In dividends?
Yeah. Crazy.
And they also... Well, that's a fat income.
Yeah. I mean, you literally don't have to do anything apart from have invested in a company before, and you're earning $800 million.
And pay a lot of tax.
I'm not saying that Warren
Buffett
Buffett is... Yeah. Yeah, but they ain't that. Your ISA allowance is $800 million, isn't it?
Yeah. Well, that's the beauty of an ISA, which we'll talk about. It's uncapped. The gains are uncapped.
But you can only put in £20,000 a year.
Yeah, but Warren Buffett's old, right? Like proper old. And if he's maxing out his ISA every year, he could probably get quite a fair way.
Yeah, but he's making $800 million a year, Matt.
Yeah, all right. Well, okay. Anyway, let's talk about ISAs, because everyone's a bit confused about ISAs. It was actually really good for me to do this, to figure out what they are. So go on, Mr. Trigg, tell us about ISAs.
So basically, but from the way I always grew up learning about ISAs, and my mum was like, they're magic. They don't let you pay tax. And that's kind of how I knew them. But basically, they allow you to earn money and make gains, but then also not have to pay any tax on it. So you can open one. There's 4 different types. So there's a cash ISA, stocks and shares ISA, innovative ISA, and a lifetime ISA. I recently got a lifetime ISA, which is brilliant. It's basically a scheme by the government. If anyone doesn't know, if everyone doesn't know, you should go and get one immediately. It's a scheme by the government to help you buy your first house, and they used to have help to buy ISAs, but they've kind of replaced them now with these lifetimes. And you open one up, and you can put a maximum of £4,000 in it a year, and whatever you put in a year, the government will pay 25% on whatever you put in it. So if you're putting in £4,000 a year, the government are paying you £1,000 that sits in that account and then earns the interest rate of whatever that lifetime ISA is. If you only put in £1,000, they're still going to pay you the 250 quid. So obviously you get that bonus as long as that money is then used to buy a house. If you don't use that money to buy a house, and you need it suddenly, you can draw it out and lose your lifetime ISA, but you don't get the bonus. So the bonus is technically still earning money, interest, but you don't get the bonus to pay for the house.
What I also found out is your lifetime ISA can either be a cash ISA, so earning interest like you said, but it can also be a stocks and shares ISA. So I have a stocks and shares lifetime ISA, so instead of earning interest, it's in theory appreciating every year and going up, hopefully. But yeah, ISAs are great. The way I think of them as like bubbles, like a bubble around my money, that can expand and it won't burst, which is great.
What's your yearly allowance, Matt?
So the yearly allowance over all four of them is 20 grand. It can be split into any of the four any way you want. So you could put 20 grand in just a cash or whatever, but you can't put more than 20 grand in at all. And one thing I didn't realize until this year is you can open one of each of them every year. So you can open a maximum of four, one of each. You can only pay into one of them each year. So you can pay into all four, but if you had four other ISAs from last year, you can't pay into two cash ISAs. You can only pay into one. So in theory, every year you could open four. So after 4 years, you could have 16 if you really wanted to.
But you can only pay into four.
You can only pay in for 4 a year. Yeah.
Yeah.
And as I said, total has to be 24.
So the
20 grand.
The benefit of that, I suppose, would be whatever one. If you have a cash ISA that's earning 0.5%, and then there's a new cash ISA that's earning 0.9%, you'd open the new one, pay into the new one, and then you can't transfer across and then still be able to pay in 20 grand. So you would, but no. you're able to put in 20 grand and then earn the new interest rate, and then suddenly you might find that account, that interest rate drops, and then the other one picks up again. So it just depends on playing the market.
So one example is, let's say you've got a stocks and shares ISA with Hargreaves Lansdown or Vanguard, and you think that's great, but then this year you want to invest in individual stocks, which I don't think Vanguard let you do. So you think, I'll open a trading 212 or a free trade one. That's the benefit, because then you can have the Hargreaves Lansdown still growing. You're just not adding to it. It's just growing. But then now you've got the trading 212 one, which is also growing, and you're adding money to it. So honestly, people don't know enough about ISAs, and they really should, because they are genuine lifesavers.
Yeah. So everyone, even if you earn a little bit of money, go and open an ISA.
It doesn't cost anything to open them, in theory.
No.
The interesting
one.
They
may not be the best interest rates, but later on in life, when you are suddenly earning money and paying tax, they are very, very beneficial for you.
I think obviously it's good for that. The stocks and shares one is the biggest one, because if you put £100 on Tesla 10 years ago, it's now going to be worth a lot more than £100. If that was not in an ISA, the government would come knocking. But if it's in an ISA, it could be millions of pounds, and the government can't say anything about it because it's in an ISA.
Would you pick the stock, Matt? So would you open the ISA and go, I'm going to open the stocks and shares ISA and I want to invest in this company?
That's completely up to you. As you could do funds, you could do individual stocks, you could do ETFs, whatever you want to do. I would, for anyone who doesn't have an ISA, I'd say open a stocks and shares ISA, open a lifetime ISA that is in the stocks and shares, a lifetime ISA that is invested in the stock market, and put your money into funds rather than individual stocks like the S&P 500. That's averaged 10%, when an average bank account gets 0.1%.
Yeah,
you could do the maths. It's terrible.
Yeah.
The lifetime ISA is great. There is a few limits to it, which I won't go into, but the total cost of your house can't be more than 500 grand or something like that. 450 grand, and other things. But on the whole, it's genuinely very good, and people should exploit their ISAs.
But yeah, so that again, it's not us saying this is how you avoid paying tax, but it's the best way of using the resources available to not pay, to keep the money that you. So
how do you think the rich stay rich? They exploit things like this.
Exactly.
It's free. You want to keep all your money. You don't want the government to steal it. So here's one way to do it.
Again, these are all recommendations, guys. We do not. This does not count as financial advice.
No, do not cut. Yeah, don't come and sue us when you lose some money.
No, you ain't going to lose any money. But if you do, please don't sue us.
Yeah,
actually, it's Matt's podcast. Sue him.
And also, all this information is on the government website, sometimes in an easy form to read, sometimes in not. But also, Martin Lewis, money saving expert.
Oh, shout out Martin Lewis. He's
absolute G. If you ever want to look anything, go look him up because.
And also, he does good. He sometimes comes on This Morning. God, I sound like a 50-year-old woman now. But he comes on This Morning, and we'll sit down, and people will ring in with their financial issues, and he'll sit down and explain it with them. So you might find that the person ringing in has the exact same issue. So go check that out as well. But obviously, after you listen to this podcast, go to the end if you don't mind.
I think we are at the end. I think we've gone over what is a tax, the different vague types, and how to pay less tax.
Should we just do a quick recap, Matt?
Tom.
I've been spending too much time with my housemates. Matt, what is a tax?
A tax is a compulsory charge put on certain things, such as a good and service or income. So the government can raise cash.
What is your personal income allowance every year?
12,500.
Very good. You sounded very confident.
Yeah, 12,500 for this year anyway. It can change.
That will probably go. I don't know if that will go. It's probably going to go down.
What is a capital gain?
So, if you in some sort of investment that you that grows throughout the year, you then have to pay tax on that growth. After 12,300.
Yep. What is national insurance?
It's a contribution to your state pension and other sort of services that happen throughout your life, funded by the government. So yeah, you'll be paying that before you're paying income tax.
And finally, what's the best way to pay less tax?
Use an ISA.
Use an ISA. I really want to actually, to end this, I really want to actually go and look into an innovative ISA because I've got a clue what they're about. It's something to do with peer-to-peer lending. So that's something I'm going to look into in the future. But for the moment, if you're a newbie, lifetime ISA, cash, or stock and shares ISA, and forget about the innovative.
Guys, the great thing about this is that we're learning. We know sort of what we're talking about, but we're learning as much as you guys are, and we're just interested in it, and we want to learn not only a way to, because we haven't been taught this stuff either, so we're learning off our own backs and finding a way to take in all that information from the government website that you don't want to read and try and verbalize it in a way that you guys can hopefully understand. But if you are confused by anything and stuff isn't making sense, put it in the comments, drop Matt a DM. Don't really know what else to do. Subscribe and just ask a question in the comments.
Yeah, I mean, if our rambling for the last, I don't know how long it's going to be, 40, who knows. If this has been of any use, please leave a like. As I said, the link down below in the description will be to the PDF. It's yours to do what you want with. Might be useful, might be of no use to you, but thank you for listening nonetheless. Next week, that's a good question. Next week, what are we talking about?
I don't know, Matt.
Let me quickly find it. Next week, it's not loading. Next week, we're going to be talking about credit cards. Big topic.
Who doesn't love a credit card, eh? Actually, I to be fair, that's such a new one for me. You got me into them, like 3 months ago? So it's the best thing.
Tune in next week to hear Ollie's credit card journey.
Oh, God. Okay, fine. Yeah, great. That's right.
But yeah, thank you guys for listening, and we'll see you next week.
Bye.